Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. It's about, let's see what time it is right now. It's about 10 minutes till 8 Eastern time. The market's not going to open up for another, hour and 41 minutes to be specific with you. Now, it's Tuesday, it's July 11th, and this is going to be a big week starting tomorrow. Now, before I get too deep into this, remember, like our channel, YouTube Wealth Press channel, subscribe to our Telegram channel. That's rogerscott.com/Telegram, or just go, there's a link below the video in the YouTube channel. And like our video and post comments below the video. I will respond. Most importantly, and this is really, really big, if you have a question, send me an email. Now, I've opened up my VIP room temporarily for the short term for the summer for everybody. It's happening today at noon. That's right, high noon Eastern time. Make sure you go there and I'll send everyone an email that's on my list. So there's a link below the video in the YouTube Wealth Press channel and you'll get an email. And there should be a link above this video if you're watching it on the Wealth Press or Roger Scott site as well. Now let's get into all of this. What are we wasting our time for? Now, as you can see here, the Nasdaq is up about 33 ticks or 33 points. The Dow's up about 48 points. This is very, very random trading action. Now, keep in mind, in light of all of this, the market's probably going to be fairly subdued today because nobody wants to make an ass out of themselves ahead of the CPI report that's coming out tomorrow before the market opens. I think volatility is really going to start up. Now, here's the thing about this report. If the report is positive, if the report is better than expected, all right, that means inflation is in fact cooling. And if the inflation is cooling, then the Fed could raise rates more aggressively. So it may be one of those situations where positive data, better than expected data, is worse for the economy than better than the economy. It's one of those things because remember, we're in an inflationary environment right now. And the Fed is going to continue raising rates for the foreseeable future. So if the economy is softer, that means they'll put on the brakes. If the economy is moving fast, then they're saying what we're doing is working. There's no need to pause. We're going to get hot and heavy. Now, it's interesting because there's already a 92 or 93% chance of them raising rates in light of what's going on. So the report, it'll be very, very, very interesting, especially for the bond market. And I think the bond market is bottoming out. And I'll tell you why. I think the report's going to be on the level. It'll confirm what the Fed is saying, and it'll confirm that the Fed is going to take interest rates a quarter of a basis point for the foreseeable future and then leave it at that. Well, that's already well priced into the bond market, and the bond market is breaking down just a little bit here, but look at how oversold it is. So I believe the bond market is going to rally off of these levels. I think it's going to be very similar to what we're seeing here. I think there's a bunch of algos suckering bonds in right here. So after we get past the 100 level, I think we'll be safe at least till the 104, 106 level. I think we'll go about halfway until the Fed, unless the Fed says, well, things are looking are doing so bad that we're not going to do anything for the foreseeable future, and that'll cause a rally. So keep an eye on the bond market, especially in light of the CPI data that's coming out tomorrow. And remember, we're looking at the core. We're looking at ex food and energy and the year over year. Nobody cares about what happened month over month. And then you have PPI report following it. It's not going to be as strong, but it'll be telling as well. And again, we're looking for year over year ex food and energy, and it's looking to be at 2.8. Anything below 2.8 is stable, and on the CPI, honestly, we're just looking for a lower number. Anything below 5.3 is okay, and year over year, they're looking at 3.1. Again, remember, this is one of those situations where good news can be negative and bad news could be positive depending on the outlook. Keep your eye on volatility. It looks to me like volatility has peaked. It doesn't look like the draft in chip stocks is continuing, which means we're probably going to get more downside. As I said, this could have peaked out around here. I was very cautious about that. So I would probably use this as an opportunity to start liquidating the position in volatility if you have a little profit on it, because I don't think we're going to see much upside till we are well into the earnings announcement. In terms of the S&P and the broad market, this is the equal-weighted S&P 500. I wanted to show you the equal-weighted S&P because it has less of those 7 stocks, quote-unquote, which has been driving the market higher. Notice where we're at right now. We're right at the upper end of a descending channel, and RSI can't even get up to this level. Look at this. Look at the price levels here are almost even, but the RSI is not, which means we're diverging. Also, there's just really no catalyst right now, and I'm not expecting earnings to show anything really all that great. Matter of fact, the only thing I could see is earnings revisions lower have stopped, which means they're status quo, but it doesn't mean earnings can overcome what we saw with AI in the last couple of months, which has been really, really up. I think we're going to see more downside or status quo, but I would be very careful, especially with the equal weighted SPY. The equal weighted QQQ, this right here, folks, I just want you to know this. This right here is Algos. This right here is Algos trying to convince us that the Nasdaq is going to go higher. There just isn't much there. There just is no catalyst there. Unless earnings tell us a different story, I just don't see it. Furthermore, if you look at sectors like XLC, the communication sector, it looks like it looks like it wants to go higher here. But look at Infotech right now, and look at. Hold on, let me show you. Communication services. It's coming down. So, again, you have an area where, look at this. Look at how often we come up here. Let me go 10 years. We don't go here very often. And when we do and we come off, which we look like we're coming off, look at XLC right now. Let me show you it. So, it looks like it's making higher highs, but momentum levels are already turning lower. Industrial stocks are also looking really overbought. Look at industrial. This is 10 years of industrial. And then look at the Dow Jones right now. Choppy. The Dow Jones, if you look at the Dow Jones over a 1-year period, and if you look at the equal weighted QQQ, if you look at the equal weighted S&P 500, you've got a descending triangle, descending channel here. I guess it's too early to talk. And you have a regular channel here. But either way, I'm not seeing any ascent. I'm not seeing anything higher. And as far as industrial stocks, take a look at how they're looking right now. They look like they want to break out, right? They really look like they want to break out. But let me show you this. You tell me if you think they're going to break out or not. 96th percentile. Look at where we're at. Look at where we're at right now. What breakout could we have here? Possibly. So it looks to me, industrial stocks have been causing the Dow to go up, right? Well, industrial stocks are grossly overbought now. Communication stocks have been causing the XLY have been causing the sector to come up, right? Well, let's look at momentum levels on both of those. Here's consumer discretionary. Right up there. Look at where we're at. And now, look at Infotech. And again, I'm looking at the 50-day, not even the 20-day right now. Look at where we're at. So, industrial up here. Infotech up here. Communication services already starting to curl down. Where's the upside here? That's the problem I'm having with this market right now. Now, we could stay hot when we go around these levels. We could stay hot for quite some time, but ultimately, I think we're going to huff and puff, and then I think earnings are going to take us down. Now, let's talk a little bit about global economy, tie everything together, and I want to go through the sectors with you and do some technicals. 3 major U.S. benchmark indices ended the regular session higher as investors digested remarks from several Fed officials, which I will talk about in a second ahead of tomorrow's report, which is the CPI. Chip stocks rose after Taiwan Semiconductor reported better than expected sales, and Intel rose over 2% on Qualcomm gain. I'm glad I'm not short Qualcomm right now. Most mega tech stocks fell, including Google and Alphabet. That's where the market cap has been. So if those stocks are falling right now, it's just not all that great. That's literally 2 out of the 7 stocks that have seen most of the ascent. Now, here's what you need to pay close attention to. And I want you to listen and listen good. Do you hear anybody? I'm going to read this, and you tell me if they sound like they're going to be lowering rates anytime soon. San Francisco President Daly said Monday a couple of more rate hikes would be needed by the end of the year. By the end of the year to address the elevated inflation in face of the robust labor market. Remember, the ADP report was strong, but the regular report was Cleveland Fed President Mester said central bank needs to lift its benchmark interest rate somewhat further. The economy has shown more underlying strength than anticipated earlier this year, and inflation has remained stubbornly high, with progress on core inflation stalling. Do you see she said stalling? She didn't say it's working. She said it's stalling. There's a 95%, give or take, probability of a 0.25% basis point rate hike in 3 weeks. So again, folks, things are not as pretty as they appear on Wall Street right now. Citigroup Monday downgraded its view on U.S. stocks to neutral, pointing to lagged effect from the Federal Reserve tightening policy and the potential for sharp and non-linear downturn. Now, that's what I'm talking about right here on the equal-weighted S&P 500, and that's exactly what I'm talking about on the industrial stocks, and that's exactly what I'm talking about the Dow stocks, which are already in range, and they really couldn't rally too much above that range right here. So again, just not seeing it. China, they're going to be boosting sentiment because they're going to be giving economic support while market participants braced for U.S. inflation data. Gains in construction and mining stocks led the stock market higher in China. That's Europe. I'm not in China yet. I'm talking about Chinese latest economic support. Boosted sentiment in Europe while market participants braced for key U.S. inflation data. Sorry about that. I thought I was in China already. Now we're in China. China closed higher following Beijing's extension of policy support to the struggling property sector, fostering expectations of new round of easing measures, which they definitely need. China released reports on Tuesday indicating the potential implementation of additional property support policies. Things are not looking good, and they're going to drag down the global economy. Japan, they snapped a 5-day losing streak. Chip stocks rose on Tuesday. Taiwan Semiconductor, they gave us a nice little boost on chip stocks, and reported boom in artificial intelligence applications. If any stock wants a boom right now, all they have to do is saying they're making waves in artificial intelligence, and the stock rallies. This is not going to last. It's like COVID. If you were making toilet paper, or if you were making anything with COVID that helped with COVID, your stock would rally. It's the same type of thing. Look at Zillow Group today. It gained over 2%. Zion Bank fell, maybe some downside for regional bank stocks, which were still short, at least till the 21st. And there's no major earnings on the table today. Now, I have already gave you a big view of of technology, and I gave you a good view of the industrial sector, but let's look at all of the other sectors. Now, just so you know, typically, I use, and somebody brought this up to my attention yesterday. Typically, I use the average. And on the average, technology, consumer discretionary, communication services are still leading, and industrial is following. But look at what this is what I was trying to say. In light of the fact that they gained so much in a 6-month period and a 3-month period, I've been looking at the 1-month period because it's been grossly different than the cumulative, and just showing you kind of where things are. And I happen to agree more with the 1-month view than I do with the cumulative view right now. Typically, I use the cumulative view, but chip and technology stocks and industrial stocks really distorted everything earlier this year. So I'm looking at the 1 month because it's giving us a much closer view of what's happening right now. And as you can see, technology is already down here. Communication services is almost at the bottom. And consumer discretionary is still holding on, maybe because of earnings, maybe because they don't have the exposure to technology as much as other sectors. But I would be watching consumer discretionary. I would be watching industrial stocks. I would be watching communication services and technology for more potential downside. I'm looking right now at basic materials to go down as well. The only thing that I'm really liking right now, let me just show you the graph. I think consumer discretionary can go a little choppy here. I think industrial is going to be topping out around here. I think real estate could potentially have a little more upside to go. I think financial could have potentially a little more upside to go. Energy, we have to keep an eye on these levels. I want to see it break above this level. Technology, communication services, I think they are on their last leg. Healthcare, I think, is going to see some positive upside. I think utilities is bottoming out. And I think consumer staples is close to bottoming out. So consumer staples, utilities, healthcare, not the sectors that have been taking us higher recently. Now, folks, before I let you go, and again, keep your eye tomorrow on the CPI and the bond market. Those are going to be the biggest telltale signs, and I'm expecting a little rally in the bond market. I may actually go long around these levels. Now, before I let you go, Folks, listen and listen good. My new data mining software has been stacking up wins on stealth stocks. Yes, stealth stocks. Faster than a pancake and IHOP. Oh, I love my pancakes at IHOP. I got to go there this weekend. Like on HON, H-O-N. Just a few days ago. Actually, we closed it out yesterday. It's my brand new patent pending software predicted a spike during the first week of July. It did. And sure enough, it soared. My followers and I got a chance to score. Listen to this. Almost 60%, 57.47% gain to be specific with you in one day, 24 hours. No day trading. Here's what some of them said. 47.67% on Han from Vesta. 64% from Robert. Steven got 42%, but that was yesterday. Today, well, you're in luck because my patent pending software, yes, my patent pending software, just flagged a new stealth stock set to surge soon, and I want to rush it to you ASAP. Click the link below, get all the details, and happy trading. You don't want to miss out. Stealth surges have been on a roll. I think we've had an 86% win rate. Make sure to like this video, subscribe to this channel. Visit our VIP room. You could find the link either in the YouTube channel or below or above this video. And I'll see you guys later. Bye.